In this video, I'll do a quick analysis of F5 networks. So F5, they're responsible for doing application delivery and security for many of the applications that you already use today, but you just might not know of F5 networks. But they're in the background working on all the delivery of applications that you use all the time. So very important company. Alright, so we're going to use the BTM Stock Analyzer or Beat the Market Analyzer. It's at btmastockanAlyzer.com to analyze the stock. Click Analyze Stocks, and we'll type in here the ticker symbol, which is FFIV. You could also type in F5 Networks here as the company name. I'll click Analyze these stocks, and then it'll come up with analysis. You can also analyze the whole S&P 500 or other indexes as well. Okay, so it says here that it's a good company at a bargain price. It's a recommended buy, and the market price is around 123, and that's what the analyzer is recommending to buy that right now. So if we look further into this company, we'll look at the summary info, and it has a report card score of 84 out of 100. Anything above 70 is considered a good potential investment. So FFIV has a pretty good score here. Let's move forward to company rating and see what's happening according to the fundamentals. So the 10-year upward price per share is a score of 15 out of 17. So this tells us that the stock has been going up in share price overall in the past 10 years. Not a perfect score though. Return on equity is 16 out of 16, so very good. EPS or earnings per share over the past 5 and 10 years is good at 14 out of 16. Ability to recover from market crash or downturn. So this looks at what happened during, let's say, the economic crash of 2008. And whether the stock was able to overcome that within a decent amount of time. Say within like 3 years, the stock price was able to recover and go above what it had before the crash or the recession. So FFIV has done that. Return on invested capital, also good score, 12 out of 12. Gross margin percent, 12 out of 12. And then PEG ratio, this tells us if the stock is seen as being able to be a long growth stock, and this is a very hard category to get a high rating in, so it doesn't have the rating here. And if you need help on any of these to understand what you're looking for, you just click on that question mark and it'll tell you what you're looking for here. Okay, so I'm going to look into these categories individually to get more details. So I just click on the ticker symbol, and it'll break it down and give me a nice chart here. So the 10-year price, share price, you could see it started at 100, and at the end of 10 years it's up around 136. So somewhere around 30, mid-30s, it has gained in absolute return over that period of time. Stock doesn't pay a dividend, and so that's not a great return actually. And when you break that down, the compounded annual return is only around 2-3%, something like that. So not very good at all. All right, if we look at the earnings per share over the past 10 years, this is pretty much picture perfect. This is exactly what we want to see. We want to see it increasing and increasing consistently over the past 10 years. And it has done that. Although in the past year it has declined, so that's something to take note of. Market recovery, this is what I was telling you about, if it can recover. So 2008, just prior to the crash, it was at 25, and then in 2011 it was at 102, so it recovered nicely. ROE, return on equity, we look for 16 and higher. Again, you just click on the question, it'll tell you what you're looking for, 16 and higher over a 5-year period. So you can see here we're over 16 on all of these years. One thing again to note is in the past year it has really gone down. Okay, ROIC, again we look at 16 or higher for this, and same as ROE, it mimics that, but a concern is that it goes down in the past year. Gross margin percent, we're looking at 30 or higher, and it has very good margins here. We can see it's above 80, and it's going up actually over the past 5 years, so this is very good. Then PEG ratio, with this we're looking for actually between 0 and 1. So because this has been over 1 each of the years, then this is signifying that it's not a high growth stock for the long term right now. Okay, let's go back and we're going to look at stock value. Okay, so stock value, this is telling us that it's expected to have an annual compounding rate of return of about 9.6%. And the estimated value of the stock is around 147, and the intrinsic value is around 140. So seeing this, we can see that it should be somewhere valued at around between 140 and 150. If we look at price, the stock price right now is actually at around 123. So this could signify that the stock is actually undervalued right now and that it could go up in price. And remember, value and price are different things. So the market sometimes misprices a stock, but the actual value is based more on the earnings and the fundamentals of the company. Okay, so the 52-week low is around 121, so we're very close to the 52-week low. So this can also signify that this might be a good time to buy. Alright, now let's go back to stock value. So now that we know that the price right now is around 123, the value we're getting around the 140 mark. If we click on intrinsic value, this will give us different valuation models. So the price earnings value model says that it's around 147. Residual income tells us more about the equity, the tangible value of the company. So we can see that it does have some value in its assets and equity, tangible value around $80. And then discounted cash flow tells us around 195. So if we click on any of these, it can give us more details of the stock. So this is telling us it's expected to grow in the next 5 years around 4.4%. If we look at the price earnings model, depending on how confident we are about the company, if we think that it's going to grow by about 10% per year, then it might be valued around $166. If we think it's going to grow around 3% per year, it might be valued around 120. And around 0% growth would be around 103. So it's important with the valuation of a stock that you focus on different valuation models to come up with some kind of ballpark figure of whether you think the stock is overpriced or undervalued. And don't just focus on one specific valuation model, because they are weighted on different metrics. So this one focuses primarily on price and earnings, whereas this one might focus more on book value or equity. This one will focus more on cash flow. So you want to mix them and look at them together. Okay, we're going to go back and we're going to look at miscellaneous fundamentals. This looks more at the balance sheet, and we could see that the debt to equity is nothing. It doesn't show up. So with FFIV, this is because the company doesn't have any long-term debt. Okay, so less than 1, that's very good. Price earnings ratio, we look for less than 16, and at 18.9, this would signify that the stock is maybe a little overpriced. But with F5 networks and some stocks, they actually have a typically high price earnings ratio. So with F5 Networks, their price earnings ratio historically has been around 21, something like that, 22. So that means that compared to historical PE ratios, this stock is probably undervalued. Current ratio should be greater than 1, and right now it's at 1.37, so this is also good. So overall, financially, the stock looks pretty good, and it could possibly be undervalued right now. As I said, they don't pay a dividend. Okay, one thing that is concerning, I would say, that really stuck out for me was when I looked at the price history over the past 10 years, and that overall, even though the company has really good fundamentals, it's just not showing in the price share price growth over the long term. So to only have about 30-some% or 2.5% growth per year in the share price is not very good. So that would be concerning to me. And the other things were the ROE and ROIC going down in the past year. Now the stock did in 2019, end of 2019, they bought a cloud-based software security company, and the company traditionally has done application delivery, and now they're moving into cloud-based software services. So this could be a change of directions for the company, and this could prove to bring in more revenue in the future. But I like to think more conservatively and think, since it hasn't happened yet and they don't have a history of bringing in this revenue from this new source, then I want to base my analysis off the more conservative and realistic view of what the company has done in the past for the past 10 years. So that's how I look at it. Overall, it looks like it's a solid company. It has consistent in earnings and everything. Just want to look at those different things that I discussed, those warnings about the ROIC, ROE going down, and the price. Why isn't the company being rewarded for its earnings, increasing consistently throughout the years, but the share price is not being rewarded? So have to look more into that before I would decide to buy this company or not. So I hope you like this analysis. If you enjoy this analyzer, then you can check in the video description and there'll be a free trial. Okay, have a great day.